Margin of Safety, by Seth A. Klarman. Introduction. Have you ever heard the old story about the sardine traders? It's a tale from the old days, back when the sardines suddenly vanished from the waters off Monterey, California. With supply gone but demand still raging, the commodity traders on the docks started bidding up the price of canned sardines. The price soared. A can of sardines, once a simple lunch, became a prized possession. One day, a trader who had just paid a fortune for a crate of these cans decided to treat himself. He took one home, opened it up, and took a bite. He immediately felt sick. The sardines were terrible. He stormed back to the cellar and yelled, "These sardines are rotten. I can't eat them." The seller just looked at him, completely unfazed, and said, "Friend, you don't understand. These aren't eating sardines. These are trading sardines." That story, as simple as it is, holds one of the most profound secrets of Wall Street, and, really, of building wealth. It reveals a deep confusion that trips up almost everyone who tries to make money in the financial markets. The confusion between the price of something and the value of something. Today, we are going to talk about a book that is legendary. It's a book so rare, so sought after, that original copies sell online for thousands of dollars. It's been called the Bible of value investing, and it was written by a man who is the polar opposite of the fast-talking, high-risk traders you see in movies. His name is Seth Klarman, and his masterpiece is titled Margin of Safety. Klarman is a quiet genius, a man who has spent his life mastering a single, timeless idea. An idea so powerful that it has protected him and his clients from the madness of the markets for decades. It's a philosophy not about getting rich quick, but about not losing money. And by the end of our time together, I promise you this, you will understand the single most important rule for building real, lasting wealth. You'll learn to see the world not as a casino of trading sardines, but as a marketplace of real businesses, real value. And you will be armed with a secret weapon that almost guarantees you'll make better financial decisions for the rest of your life. That weapon is the margin of safety. So, let's begin our journey and unlock its secrets together. Book Summary. To understand the wisdom of Seth Klarman, we first have to understand the world he is reacting against. Imagine stepping onto the floor of the New York Stock Exchange. The flashing lights, the shouting, the frantic energy. It feels like the center of the universe. But Klarman asks us to see it for what it often is, a giant casino. It's a place where billions of dollars are whipped from one investment to another based on whispers, rumors, and fleeting emotions. A place where the vast majority of people are not investing, but speculating. And this is the first great lesson from Margin of Safety. The crucial difference between an investor and a speculator. A speculator buys a stock hoping the price will go up next week, or even tomorrow. They don't know much about the company. They don't really care what it does. To them, a stock is just a piece of paper, a trading sardine. Their success depends entirely on finding someone else, a greater fool, willing to pay a higher price. It's a game of guessing what other people are going to do. An investor, on the other hand, thinks completely differently. An investor buys a stock because they are buying a fractional ownership in a real business. They care about how much cash the business generates. They care about its long-term prospects. They buy bonds because they are lending money to that business. They aren't trying to guess the market, they are trying to understand the value of the business itself. They are interested in eating the sardines. The problem is, the entire system of Wall Street is designed to turn us into speculators. Think about it. The stockbrokers, the investment bankers, the talking heads on TV, they get paid for activity. They make money on commissions, on fees for new deals, on the sheer volume of transactions. It doesn't matter to them if your investment is a winner or a loser in the long run. What matters is that you do something. Buy, sell, trade. This creates what Klarman calls a powerful bullish bias. Everyone has an incentive to be optimistic. The brokers have happier customers in a rising market. Companies want their stock price to go up. Even the government regulators seem more concerned with preventing a panic than with stopping an irrational bubble. It's a grand conspiracy of optimism, where everyone is cheering for higher prices, regardless of the underlying value. And then there are the institutional investors, the giant pension funds and mutual funds that control trillions of dollars. You would think they are the sober, long-term thinkers in the room. But they are trapped in what Klarman calls the institutional performance derby. Their performance is measured every quarter, sometimes even every day, against their competitors and against market indexes like the S&P 500. If a fund manager has a bad quarter, their clients might pull their money. So, what do? They play it safe. They buy what everyone else is buying. They follow the herd. To act independently is to risk being wrong and alone, a career-ending move. It's better to be conventionally wrong than unconventionally right. The result is a giant herd of financial behemoths, all chasing the same popular stocks, driving their prices up to absurd levels, while ignoring or trampling over other, less fashionable securities. This creates a market that is far from efficient. It's a market driven by emotion, by greed when prices are rising, and by fear when they are falling. And it's in this chaotic, emotional world that the value investor finds their greatest opportunities. So, if the game is rigged and the herd is running wild, how does a thoughtful person navigate it all? It starts with meeting a very peculiar character. A character invented by the father of value investing, Benjamin Graham. His name is Mr. Market. Imagine you own a small piece of a private business, and you have a partner named Mr. Market. Every single day, without fail, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his, at a specific price. The thing about Mr. Market is that he's a manic depressive. Some days he's euphoric. He sees nothing but a golden future, and he offers you a ridiculously high price for your share. Other days, he's gripped by despair. He sees nothing but trouble ahead, and he offers to sell you his share for pennies on the dollar. A speculator, hearing Mr. Market's daily prices, would think he has valuable information. When Mr. Market is optimistic and offering high prices, the speculator gets excited and buys in, thinking the price will go even higher. When Mr. Market is panicking and selling cheap, the speculator gets scared and sells, thinking things are about to get worse. The speculator lets Mr. Market's emotions dictate their own. The value investor, however, sees Mr. Market for what he is, an emotional, irrational partner whose mood swings are there to be exploited, not followed. When Mr. Market shows up in a panic, offering to sell his shares for far less than the business is actually worth, the value investor happily buys him out. When he comes back in a fit of euphoria, offering to buy those same shares for an absurdly high price, the value investor happily sells them back to him. The key is this: the value investor has done their own homework. They have formed their own opinion of what the business is worth, independent of Mr. Market's daily price quote. The market's price is a serving mechanism, not a guiding mechanism. It's there to serve you with opportunities, not to tell you what to do. This simple allegory contains the very soul of value investing. It's about thinking for yourself. It's about separating the volatile price of a security from the more stable underlying value of the business. And that leads us to the central pillar of Seth Klarman's entire philosophy. The concept that gives the book its name, the margin of safety. Warren Buffett, another student of Benjamin Graham, explains it with a beautiful analogy. He says, when you build a bridge, you insist that it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. That 20,000-pound cushion, that is the margin of safety. In investing, the margin of safety is the discount between the price you pay for a security and its underlying value. If you've done your homework and calculated that a business is worth $1 per share, you don't buy it at $1. You don't even buy it at 90 cents. You wait patiently until Mr. Market, in one of his dark moods, offers it to you for 50 or 60 cents. That gap, that 40 or 50 cent discount, is your margin of safety. Why is this so crucial? Because the future is unpredictable. Because your analysis, no matter how thorough, might be wrong. Because bad luck happens. Because the world can change in ways nobody sees coming. The margin of safety is your protection against all of those things. If you buy at a 50-cent discount and your valuation was a little bit off, you're still likely to be okay. If the business hits a rough patch, your cushion protects you from a big loss. If the market panics and the price drops even further, you're not scared. You're excited, because you know you have a huge buffer. This is what makes value investing a fundamentally risk-averse strategy. Most people think that to get high returns, you have to take high risks. Klarman argues that this is a dangerous myth. High returns are often found in low-risk situations, precisely because the market has mispriced the risk. The goal is not to bear risk, but to be compensated for the risk you do take, and the best way to do that is to buy with a massive margin of safety. This requires a certain kind of temperament. It requires patience. Warren Buffett uses another great analogy here, from baseball. He says investing is like a game where you stand at the plate, but there are no called strikes. You don't have to swing. You can watch hundreds of pitches go by, pitches that other batters are swinging at wildly, and wait for the perfect one, the one right in your sweet spot. For the value investor, that perfect pitch is an undervalued investment opportunity. There may be times when no such pitches come along. In an overvalued market, the cheapest security might still be too expensive. And in those times, the value investor is content to do nothing. They will happily hold cash, waiting patiently. They are not pressured to invest prematurely. This is perhaps the hardest part. Standing apart from the crowd, challenging conventional wisdom, and opposing the prevailing investment winds. It can be a lonely undertaking. During bull markets, a value investor might look foolish as they underperform the high-flying speculative stocks. But over the long run, the value approach has proven to be so successful that very few who truly adopt it ever abandon it. So, the philosophy is clear: wait for the perfect pitch, and demand a margin of safety. But where do you actually find these opportunities? Where does a value investor hunt for these 50-cent dollars? Klarman tells us that you don't find them by trying to predict the future of the economy or the direction of the stock market. That's a top-down approach, and it's a fool's game. You have to be right about the big picture, right about the industry, right about the specific company, and right about the timing. The chances of getting all of that right consistently are close to zero. Instead, the value investor uses a bottom-up approach. It's like being a detective, examining one specific case at a time, looking for clues that others have missed. You search for bargains, security by security, analyzing each situation on its own merits, regardless of what the broader market is doing. Klarman points to several specific hunting grounds where these mispricings are likely to occur, often because the institutional herd is forced to sell or is simply not looking. One of the most fertile areas is in what are called spin-offs. A spin-off happens when a large parent company decides to get rid of a subsidiary by distributing its shares to the parent's own shareholders. Imagine a giant company like Tandy Corporation, which in 1986 spun off its international retail operations into a new company called Intertan. Now, think about a massive institutional investor, say a pension fund managing $1 billion. They might own a $40 million position in Tandy. After the spin-off, they suddenly find themselves owning a tiny $2.2 million position in this new, obscure company, Intertan. What do? A position that's small is barely worth tracking. It doesn't move the needle on their overall performance. Plus, they probably know nothing about it. The path of least resistance is to just sell it, regardless of the price. Index funds do the same. If Intertan isn't in their assigned index, they sell. Period. The result is a flood of indiscriminate selling from people who are not selling because they think the business is bad, but for purely structural reasons. They aren't even looking at the value. And for a brief period, the price of the spin-off can fall to absurdly low levels, creating a fantastic opportunity for the value investor who has done their homework. In the case of Intertan, the stock was trading at $11 per share, while the company had net working capital, basically, the liquidation value of its current assets, of roughly $11 per share. On top of that, it had highly profitable operations in Canada and Australia that were being masked by losses in Europe. Investors were essentially getting the profitable parts of the business for free. As the company sorted out its problems and the forced selling subsided, the stock soared over the next few years. Another fantastic hunting ground is the world of financially distressed and bankrupt securities. When a company gets into trouble, most investors panic. The word bankruptcy conjures images of failure and total loss. The herd rushes for the exits, selling everything associated with the company at any price. But the value investor knows that a bankruptcy filing is often a catalyst that can unlock tremendous value. It's a legal process designed to reorganize a business, not necessarily to liquidate it. A great example was Texaco in 1987. The company was forced into bankruptcy because of a massive $10 billion legal verdict against it. The market panicked, and Texaco's stock and bonds plunged. Many institutional investors were forced to sell simply because their rules forbade them from owning bankrupt securities. But a careful analysis showed that Texaco's assets were worth far more than all of its liabilities, even including the worst-case scenario for the lawsuit. The senior bonds of the company were almost certain to be paid back in full, with interest. By buying these bonds at a steep discount from panicked sellers, investors were able to achieve spectacular, low-risk returns as the company worked its way through a relatively quick reorganization. It was an opportunity created entirely by fear and institutional constraints. A third area, and one that is particularly fascinating, is thrift conversions. For decades, many local savings and loan institutions, or thrifts, were mutually owned. This means they were technically owned by their depositors. In the 1980s, hundreds of these thrifts began converting to stock ownership through an initial public offering, or IPO. Now, a typical IPO is often a bad deal for the public. Insiders who bought shares for pennies years ago are now selling them to you for $20. But a thrift conversion is completely different. In a thrift conversion, there are no prior shareholders. All the shares that will exist are sold in the offering, and all the money raised goes directly into the company's treasury. Here's the magic: that new money is added to the pre-existing capital that the thrift already had. Imagine a thrift with a net worth of $10 million. It decides to raise another $10 million by selling 1 million shares at $10 each. After the offering, the thrift now has a net worth of $20 million and 1 million shares outstanding. The book value is now $20 per share. The investors who bought at $10 per share immediately have a claim on $20 of book value. You are essentially buying your own money back and getting the pre-existing bank for free. This simple, powerful arithmetic, combined with the fact that these small, local banks were often ignored by Wall Street, created an incredible stream of opportunities for value investors throughout the 1980s and beyond. The 1990 conversion of Jamaica Savings Bank is a perfect example. It was an incredibly conservative, well-capitalized bank that went public at less than 50% of its book value in the middle of a real estate downturn and a national panic about the thrift industry. The market tarred it with the same brush as all the failing thrifts, creating a low-risk, high-return opportunity for those who bothered to look at the specifics. These are just a few of the hunting grounds. Klarman also discusses liquidations, complex securities, and risk arbitrage. The common thread is that they are all areas where structural factors, complexity, or fear cause prices to diverge from underlying value. Of course, finding a potential opportunity is only the first step. The real work is in the valuation, the art of figuring out what a business is actually worth. And Klarman is adamant that valuation is an art, not a science. Anyone who tells you they can pinpoint the value of a business down to the penny is either fooling you or fooling themselves. Business value is not a single number, it's a range. And that range is constantly shifting with the economy, with competition, and with 1,000 other factors. Because of this imprecision, the value investor must always be conservative. Klarman describes 3 main approaches to valuation, which should be used to cross-check each other. First is an analysis of going concern value, often using a net present value, or NPV, calculation. This involves projecting a company's future cash flows and discounting them back to today. The problem, of course, is that forecasting the future is a guessing game. A small change in your growth assumptions can lead to a massive change in your valuation. For this reason, Klarman warns against falling in love with fast-growing companies where the valuation is highly dependent on optimistic projections far into the future. Your forecasts must be relentlessly conservative. The second method is liquidation value. This is a worst-case assessment. What would the assets of the business be worth if you had to sell them all off? What could you get for the inventory, the real estate, the equipment? This method ignores intangible assets like brand names and focuses only on hard, tangible assets. When a stock is trading at a discount to its liquidation value, you have a powerful margin of safety. You're analyzing the business on the basis of what it's worth dead, and if that's more than the current price, the upside from it surviving is essentially a free option. The third method is stock market value, or what he sometimes calls private market value. This involves looking at what comparable businesses are trading for in the stock market or what a savvy business person has recently paid to acquire a similar company in its entirety. This can be a useful shortcut, but it's also dangerous. In the late 1980s, for example, junk bond finance takeovers were happening at crazy multiples. Relying on those prices as a guide to value was a recipe for disaster, because the buyers themselves were being irrational. You have to use conservative, historical standards, not the ephemeral prices of a market fad. By looking at a business from these 3 different angles, an investor can triangulate a conservative range of value. And only when the market price falls significantly below the low end of that range does an investment opportunity appear. This entire process, the philosophy, the hunt, the valuation, requires discipline. But the final piece of the puzzle is portfolio management and trading. It's about how you act on your analysis. Klarman offers a few simple, powerful rules. First, leave room to average down. Never buy your full intended position all at once. If you've identified a true bargain, you should be thrilled if the price drops further after your initial purchase. It gives you the chance to buy more at an even better price, lowering your average cost. If the thought of a price drop scares you, you probably haven't found a true investment, you're speculating. Second, Selling is the hardest decision. When you buy, you have a large margin of safety. As the price rises toward its underlying value, that margin shrinks. Your potential return gets smaller, and your risk gets bigger. There's no magic formula for when to sell. The only rule is that all investments are for sale at the right price. The decision depends on the underlying value and, just as importantly, on what other opportunities are available. It's foolish to hold on for the last few pennies of gain in a fully valued stock if the market is offering you a fresh set of bargains elsewhere. And finally, Klarman reminds us that despite all the analysis, investing remains a human endeavor, fraught with emotion. The key is to resist fear when others are panicking, and to resist greed when others are euphoric. The value investment philosophy is simple to understand, but it is difficult to implement. It requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. But it is a path paved with logic, reason, and a deep, abiding respect for the power of not losing money. It is the path of the wise investor. Commentary. As we step back and look at the landscape of Seth Klarman's margin of safety, what's truly striking is how simple and timeless the core message is. In a world that relentlessly pushes us toward complexity, speed, and speculation, Klarman's philosophy is an anchor of profound simplicity: figure out what something is worth, and pay a lot less for it. It's a message that is more relevant today than ever. We live in an age of financial noise. We are bombarded with hot stock tips on social media, cryptocurrencies that promise to change the world overnight, and a 24/7 news cycle that magnifies every market fluctuation into a major event. It is an environment perfectly designed to activate our worst impulses: greed, fear, and the fear of missing out. Klarman's work is the antidote to that noise. It's a call to turn down the volume, to step away from the crowd, and to return to first principles. The principle that a stock is not a lottery ticket, it is ownership in a business. The principle that risk is not volatility, it is the probability of a permanent loss of capital. And the principle that the future is fundamentally unknowable, making a margin of safety the only rational protection an investor can have. For someone just starting out, say a curious 17-year-old, these lessons are not just about investing. They are about life. They teach a way of thinking that values substance over hype, patience over impulsiveness, and independent thought over herd mentality. So how can you, right now, begin to apply these powerful ideas? You don't need a brokerage account or thousands of dollars to start. You can start with your mind. First, the next time you hear someone talking excitedly about a stock, a coin, or any investment, ask yourself a simple question: are these eating sardines or trading sardines? Are they talking about the underlying value of the business or asset, its cash flows, its competitive position? Or are they just talking about the price and where they hope it will go next? Just learning to ask that question will put you ahead of 90% of market participants. Second, become a student of value in your everyday life. You don't need to analyze complex financial statements. Pick a company you understand. Maybe it's Nike, or Starbucks, or the company that makes your favorite video game. Start thinking like an owner. If you had to buy the whole company today, what would you pay for it? What are its strengths? What are its weaknesses? This simple mental exercise trains you to see the world through the eyes of an investor, not just a consumer. And third, embrace patience as your superpower. As a young person, your single greatest advantage is time. You are not in a rush. You are not in the institutional performance derby. You can afford to let hundreds of pitches go by and wait for the one that is so obviously a bargain that it feels like a sure thing. In a world that prizes speed, the ability to patiently do nothing is one of the most powerful skills you can cultivate. Margin of Safety is more than a book about investing. It's a masterclass in rational thinking in an irrational world. It provides a framework for making decisions under uncertainty, for managing risk, and for building a foundation of financial security based on discipline and common sense. That was a summary of Margin of Safety by Seth Klarman. We've certainly covered the big ideas today, but I'll be honest with you, a summary can only ever be a map. The real treasure is found when you walk the path yourself. The true magic of a book like this happens in the quiet moments of reading, when a particular story or a simple phrase connects with you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has resonated with you, I encourage you to seek out a copy. Reading it isn't just about learning financial techniques, it's an experience that can genuinely change the way you see the world of money and your place in it. Also, if you found this journey valuable, please take a moment to like this video and subscribe to the channel. It lets me know that we're on the right track, and it ensures you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.